So Luke, it's a great opportunity to be here with you at Real Vision headquarters. I'm especially looking forward to it because I cannot tell you how many times I will meet people at conferences or talk to them on the phone, or they'll send me an email and they'll say, I saw you and Luke Gromen on Twitter talking about, So it seems like half of my conversations with new people involve you in some form or another, even though you and I don't get to talk directly all that often. So this will be good.
Yeah, absolutely. I'm glad I get some of the similar feedback on Twitter. So it's always good to actually sit down and talk face to face.
Yeah. So obviously everybody hears us talk about the dollar a lot, and I think we can maybe touch on that a little bit again. But one of the things that also goes along with the dollar is gold. I don't know that me and you have ever really talked that much about gold. Maybe we have a little bit here and there. So I thought we could touch on the dollar a little bit more if you want to, but we can talk a little bit more about gold,
Sure.
kind of where you see it's going.
Yeah, I'd be happy to. Yeah, for me, gold is. I think about gold differently, I think, than some people do from really two ways. I think number one, I think gold is really useless for about 99% of the long economic cycle. And then in the 1% of the economic cycle, the long economic cycle, which tends to correlate or coincide with sovereign debt bubbles globally, it's critical to own. And so the overriding, never had much interest in gold before 2008, and I think it's an important asset to own some of, because I think we are in the midst of a global sovereign debt bubble that's begun to unravel. And then I think there's also another way that we've thought about gold and talked about gold a lot, which is it is being leveraged by a couple other countries, and China in particular, as a means of gaining credibility for China to be able to print yuan for oil and other imported commodities. And so I have a lot of people ask me, hey, why do you think China's buying so much gold? Why are they importing so much gold? What's the end game? Do they want to back the yuan with gold? And I suppose that's possible. It's not how I see them using it. What I think they're doing is what China's doing with gold is not about gold. It's about oil. It's about copper. It's about iron ore. In that they are basically appears to have reopened sort of a version of the Bretton Woods gold window where the right way to think about it, in my opinion, is China's wanting to use or at least offer gold as sort of a treasury bond settlement, a treasury bond settlement instrument under the post-Bretton Woods system that the United States has shared. So that's those are two different ways that we are thinking about gold at the present moment.
And so do you personally own gold, or do you recommend people buy gold, or are you recommending miners or physical, or what's kind of your view as far as an investment? And that maybe you don't give investment advice, but I'm just curious.
No, I do own it personally. I never owned any before 2008, and have held it the entire time. It's a good sized position for myself. And I think everyone at this particular moment in the long cycle, I think, should own some because history is replete. The sovereign debt always defaults, always. And you're at that moment in time where, we have too much. There's a sovereign debt bubble. No one is up until recently, no one was questioning the credibility of sovereign debt, particularly in the Western side, Western sovereign debt markets. I don't think we're fully there yet, but we've already run the playbook. Well, we'll grow out of our sovereign debt. We tried, it didn't work. Well, we'll financially repress out of our sovereign debt. We tried, it didn't work. Populism's breaking out. And so sort of the last step in that whole process, and the IMF has written about this, a number of different white papers of the roadmap. The last one is a devaluation of the currency or other sort of really inflating your way out of it. And so we're sort of down to the last possible way out of it. So I think now perhaps more than ever, I think you said, we were talking earlier, you've been surprised how long things have sort of taken to sort of go down this path post 08, and I have been as well, to be honest. But I think now is a point in time where you don't know the exact timing, but you know that there's sort of 3 or 4 steps they can do, and they've tried 2 or 3 of those steps and they haven't worked, which tells you, the fat ladies, were probably warming up, just off stage.
Yeah, it's interesting. I've been a huge gold advocate for a number of years, and usually when I usually talk about gold, mainly because I think I have a unique view on it to a certain extent, and there's plenty of people talking about equities and fixed income and private equity, and I didn't really feel like I necessarily had an edge there, and I felt like I had a little bit of an edge in the gold world. But along those lines, it has surprised me how long it's taken. And based on a few things that's happened in the last 12 to 18 months, I actually think it's going to take a little longer. And so that's, I don't know if I told you this or not. I think I mentioned to you just briefly before we came on, but I actually shut my gold fund as of the end of the year.
Okay.
And that's, it's kind of a hard deal for me, to be honest, because I'm such a huge believer in it. But it was always a very small part of my business, less than 5% of my assets under management and less than 5% of my overall business. But I always felt like it was the most important part because I really think that when the time comes, everybody needs to own it. But what a lot of people don't know is when you own gold in a fund structure, there's all these expenses that nobody knows about, right? There's audit, there's administration, there's tax, there's legal. And when I started, it was just the precious metals allocation for my current clients. And thought, as we get into a bull market, we'll be able to raise more assets. Well, 7 years into the bear market, and we weren't able to raise additional assets. And with poor performance due to the gold price, we just weren't. The expense ratio kind of became too much, and I really couldn't justify it. And it was kind of a hard conversation with clients, to be honest, because I've advocated it for so long. And at first they thought I was saying, well, we should not be in gold anymore. And then then I had to explain, no, we should still be in gold, but there's more efficient ways to do it than through this particular fund structure. I was always in kind of an interesting position, and I'm interested to get your thoughts on this because I don't know what you think it's going to do right now, but I was always somebody who said, it's the hedge against everything else. We're not going to get rich owning gold. It'll hopefully save us when everything gets really bad, but it was never the play to make a lot of money. And so I was always one of the few people, at least I felt, and there's probably a few more out there in the gold world who, if I thought gold price was going to fall, I would say it was going to fall.
Right.
And then people would say, how can you be a gold manager? How can you recommend gold, but also say it's going to fall? There's some contradiction there, right?
Yeah, sure.
And so I would have to explain that, it's the insurance policy. Right. You buy car insurance, you buy fire insurance, you don't necessarily want your house to burn down.
That's right.
But when you're in the investment world, people don't always see it that way. And so I tried to figure out a way that I could, have that insurance along the way and protect them if this thing extended longer than I thought. And the reality, I wasn't able to do it. Sure. And so eventually had to come to the realization that as much as I wanted to keep it open, it wasn't in the client's best interest to do it.
Good on you
for
doing that, right? That's a high integrity move.
But it's it's part of this business, and it's part of the people talk about skin in the game. To be quite honest, I'm embarrassed about it. I'm embarrassed that I wasn't able to get through the cycle. I feel like I should have done a better job. But the flip side is that I think if you always do right by your clients or try to do right by your clients, in the end you'll be okay. Mm-hmm. But I think it's an interesting time because I actually think that gold is going to go lower over the next couple of years, and I know that that's a little interesting again for a gold guy to say that. But you and I have talked about the dollar a lot. And I've maintained for a while that eventually the dollar and gold will go higher. But I think that in the short term, because of the dynamics of the way the dollar's, how I believe is going to play out, I actually think I'm going to get an opportunity to get back in, maybe even at a better price. But I'm curious what you think about gold and the dollar in conjunction.
Sure.
Do you think gold's going higher here? Do you care? Is it just an insurance play for you?
No, to me, one thing I've said a number of times, and I still think it's true, is I don't think gold is a real market, and I don't think it's been a real market since probably 2013. There were a number of things that happened beginning in early 2013, shortly after Cyprus announced that they were getting a bailout and they were going to get $10 billion in loans, and that they were going to write a promissory note, and they were going to also shed or sell 10 tons of gold. And it was odd. I don't know what to make of it, but I know that if you divide $10 billion in loans for 10 tons of gold, I would love to lend my gold out at that because that's about $46,000 an ounce. So if anyone out there wants to provide me loans at that collateral value, I'd be happy to part with it for that rate. But in all seriousness, what was really interesting is shortly after that happened, you had what was effectively a run on physical gold begin globally. Chinese purchases ramped up. You saw gold forward rates shortly thereafter invert. You saw, I had a very interesting conversation with a very large physical gold holder in the United States that I had a relationship with at the time. And their comment to me was, to frame up, if they would have been ranked as a sovereign holder, they've been a top 20 sovereign holder in the world. So they owned a lot of physical. Allocated. They received a call shortly after one of the bulge brackets had downgraded gold to a sell. same bulge bracket, called them up and said, hey, here's why we're downgrading it, and we think you should sell it, and we stand ready to buy anything you want to sell. And this person, is further indication of other things I'd been hearing at that point in time, that there's something happening here in terms of physical demand detaching from the paper market. And when I say detaching, really it ties back to my point of why I don't think it's been a real market since 2013, and that is that you've seen a very steady flow of physical from west to east. It's a fairly opaque market, but the Swiss import-export data is a decent picture, and it's crystal clear what's happening. It's flowing from west to east, and in particular post 15 or 16, it's interesting. Goldman has written a number of times that when the renminbi falls against the dollar, imports of gold rise into China. And so to me, I think after 5 or 6 years of this process, to me, what appears to be happening is that gold is effectively serving as a governor on how far and how fast the renminbi can fall against the dollar. In other words, because the supplies of physical sort of are theoretically finite, at least at certain price levels, every time the renminbi falls, imports into China go up, vaults in London and the U.S. get drained because it can't come out of China, because once it's in China, it doesn't leave China by and large, at least in the volume. So to me, it almost seems like it's the physical market. I won't say go all the way to it's tightening or it's imminent but it seems like there is actually a mechanism that is being put in place by all of this dynamic that is beginning to wind or close the gap between at least making the physical market have some semblance relative to paper, because what you saw in 2013 is you just saw the paper contracts outstanding increase.
Well, what I think is interesting about that is, back in 2013 and 14, I saw a lot of the same things. I wrote about the same things. I put out, a number of research about it. But by and large, a lot of that has gone away over the last couple of years. You still see the flows. Mm-hmm. Leave London, leave Switzerland, go to Hong Kong, go into China. Yep. You see all that. But if you talk to bullion dealers, or if you talk to vault operators, or if you talk to refiners, they've got plenty of gold.
They got plenty of gold.
There's not a shortage of physical.
Right.
So I kind of find that interesting. Again, I would have thought that it would have changed earlier, but the fact that it hasn't, it's made me think about it in a different way. And this kind of gets back to our whole dollar discussion. And I want to ask you something about something you just said. Part of the reason I'm going to ask you is people ask me about you all the time, and I want to make sure I'm not putting words in your mouth, because I would hate it if somebody did that to me. But you've talked a lot about China figuring out a way to print yuan versus commodities, and also a way for people to sell their goods for yuan and then immediately go into gold so that they don't have to hold the yuan. Two questions. You just said a minute ago that gold goes into China and it never leaves. But if somebody's going to sell their commodities for yuan and then buy gold, and they want to take it out, won't you see gold leave?
Not mainland. No, if you look at how they've set it up.
So it's your gold, but you have to own it in China?
No, so you have Hong Kong, where it can come and go in and out of Hong Kong. It can come and go in and out of Shanghai International, the free trade zone. As a practical matter, not a lot moves there.
Right.
Dubai, it can come and go. There's a yuan gold contract there, and oil, in theory, would be willing to transact for gold in yuan make that convenient. Yeah, obviously, it's a financial center in the Middle East, so it's a two-tiered market almost, right? The gold that goes into mainland China, it's almost as if China understood the Bretton Woods system and the faults with the Bretton Woods system, and they were twofold. Number one, the U.S.'s gold was finite. We weren't going to let it all go. And number two, the price of gold was fixed, which is a bad idea. They're not going to be able to maintain either your volume, your tonnage, or your price. One of those two are going to have to break, and we actually broke them both. You can't get the gold, and the price and the price rose. China seems, by looking at the system they have appear to have set up, the gold that's in mainland is their gold. Yep. You are free to exchange offshore renminbi if you so desire. Now, as a practical matter, it's not like every offshore renminbi is going to get exchanged for gold. It's going to be, Chinese goods, Huawei equipment. It happens to be they're one of the biggest trade creditors in the world, right? So if you're Russia, 10 years ago, it was trinkets. It was, housewares. Now it's 5G, hypersonic weapons, et cetera. There's real trade goods there. But if you have a net surplus still against the Chinese, and as a practical matter, other than South Korea, they tend to be commodity exporting nations that are running surpluses against the Chinese, then if you can put some into Chinese financial markets, Chinese government bonds, and some into gold. Now that gold will have to come from Hong Kong, Dubai, or the Shanghai Gold International Board. That then has to come from one of three places: UK vaults, US vaults, and US mines and vaults, or India. And so it's been interesting, right? UK doesn't have any mines to speak of, so that's just vault dishoarding. The US, you have mines and vaults, and that's probably, to some large extent, US mine production heading east. India, you've seen some more impetus behind trying to financialize gold, which is a way of saying, take the physical off them and give them a paper receipt, which would sort of buy time, which is interesting, I think, to me, when you sort of look at those initiatives through this lens. But ultimately what this does is it sets up a London gold pool 2, if you will. We've seen this movie before from 65 to 71. Foreign creditors decided they didn't want to stockpile treasuries ad infinitum to finance Vietnam and Great Society. They started asking for their gold back. The price of gold didn't move even though physical volumes were flowing. And then all of a sudden one Sunday night, Nixon said, we're done. In fact, there's another interesting, with the U.S. just asking the BOE not to release gold to Venezuela, the U.S. actually asked England to shut down the gold market in the late 60s for a couple days till they figured things out. What it sets up, this sort of London Gold Pool 2 dynamic, is a choice. You can either let the gold move at the same price, the physical move at the same price, and just increase your paper leverage. And so you get a sort of a dollar gold peg price behavior, which is what we've had since 2013, effectively. More and more leverage
in the band.
In the band, it's called 1150 to 1350 band. Or you can let the gold price move in response to that demand. But if the gold price is moving, to your point before, you're talking about a dollar devaluation, right? So now, if China buys gold, or if there is concern about the renminbi and people buy gold on concern about the renminbi and the gold price rises, they're not just devaluing the renminbi against gold, they're devaluing the dollar against gold too. It's a natural hedge. It's very elegant. Or you can not give them their gold. One day you just say, sorry, no. And that, I think, is also, I don't think that's imminent. I think that's something that would likely not be dollar positive if that were to ever happen again. It certainly wasn't the last time it happened. And so that's what I think China is doing with gold. Is it's not all going to settle in gold, but it's this, it's creating this London Gold Pool 2 dynamic with an improved sort of Bretton Woods system.
Again, I find this fascinating because I look at the same information and I kind of come to a different conclusion. Probably not.
I would expect no less.
I guess I kind of feel like, if China is becoming this new power and they're, wanting to not necessarily replace the global reserve currency, but be in the basket of reserve currencies or one of the major currencies, they don't have an open capital account. They're saying to the world, you don't have to hold our currency. You can exchange it into gold. Mm-hmm. Well, to me, that's not like a good argument for owning the renminbi. And to me, it's telling me that...
That's the argument the U.S. used at Bretton Woods.
Yeah, but we're in a little bit different position then, right? Than China is now.
Yes and no. Certain ways yes, certain ways no.
But I'm just saying, if China wants to have the yuan be a major currency, why are they saying that? And if they're in such a better position than the U.S., why are they saying, well, you don't have to hold our currency, you can hold gold? To me, that's a little funny.
I would look at it as so. Like I said, the Bretton Woods, the deal was you can hold dollars or you can hold gold.
Yeah.
And of course, when push came to shove, we were kind of like, yeah, we're just kidding. Don't take that gold.
Yeah.
I think when the U.S. once we switched to, you can't have gold, but you can have treasury bonds.
Yeah.
It's a great deal for the U.S. and that system worked. Importantly, the U.S. gave what Volcker did in the early '80s gave that system tremendous credibility. We came out and we said we are willing to blow up the U.S. economy to keep the purchasing power of your dollars consistent in oil terms, in commodity terms, in your critical import terms. And so the world said, this system's got issues, but you know what? The Americans are willing. It's For all of in 1970, it's our currency, but it's your problem. In 1980, Volcker said it's our currency and it's our problem. And he bought us 30 years of credibility, maybe 35 years of credibility, or it's 20 years of credibility, 25 years of credibility. It was sort of early part of the 2000s when you have, the deficits for the war, et cetera, and it became it's our currency and it's your problem again. And China's system is it's our currency and it's our problem. In other words, what they're saying is if the U.S. prints $100 trillion for Social Security and Medicare, sorry, right? The price of oil for everyone on the planet is going to go through the roof and people are going to starve. And sorry about your luck. And we're going to have to print that money. With China's system, if China prints 100 trillion yuan or whatever the equivalent is for Social Security and Medicare, everyone can show up and bid for gold in yuan. And the price of gold rises in yuan terms. The purchasing power of their creditors in Chinese goods terms remains constant. And the American deal is not keeping that constant.
But can't it happen in American terms too? Like people can exchange their treasury bonds for gold right now. People can exchange their dollars for gold right now. It's not automatic, but it's one more step, and it happens in the most liquid market in the world. Sure. So why is it so hard?
Well, you and I could. If you and I were ruling countries, we couldn't. We could ask Saddam about that. We could ask Gaddafi about that.
Yeah, but if
there's
Britain,
geopolitical realities there that...
No, absolutely. But I guess I struggle to find out why are they going to be able to do it with the Chinese gold contract?
Because China's not the reserve currency of the world. That's the one thing the dollar has that the yuan doesn't, that the renminbi doesn't, is that the Americans absolutely could do that. And the only thing keeping them is they would be giving up a credit card that has no limit and that is always rolled over and that has, that the balance can grow and grow and grow. It's the reserve current. Washington will lose its ability to run deficits without tears if they did that.
But wouldn't that hurt everybody else initially just as much as it hurts us? I think this is something I want to kind of dig a little bit deeper into with you is, do you see a situation where the U.S. could go into a severe recession, but everybody else would be okay?
It depends. If the dollar strengthened, no. If the dollar weakened tremendously, yes. And the reason I say that is to your point, everybody's short all these dollars. What we saw it in 2017, right? Everyone came into 2018, coordinated global growth. That was the theme last year at Davos. Yeah. It wasn't coordinated global growth. You know what it was? It was the dollar was down 12% in 2017. Exactly yeah. Everyone was able to cover their dollar short, 12% lower. Now cover your dollar short down 30%. Cover your dollar short down 40%. But everyone's going to be richer.
Well, it helps from that perspective, but if the U.S. is in such a severe recession that the dollar's down 20 or 30%...
It'd have to be a special kind of recession.
Well, I'm saying nobody else's GDP numbers and growth numbers are the same because we're one of their biggest customers. So,
right.
So you got to reset all those ratios.
Oh, no question. It's going to be weird, and that's why I didn't want to... the odds are that no, the world couldn't grow, certainly to potential, if the U.S. was off the map. But there's a lot of conditions to that. Again, if it is the dollar goes up, no, we're seeing that. There are no winners from a stronger dollar. Full stop. Weaker dollar, there are some losers. There's a whole lot of winners. If you're short the dollar, and everybody's short the dollar, from Uncle Sam to you and me, to corporate America, to China, all across the world, everybody's short a lot of dollars, and the dollar goes down. It's like paying your mortgage in a currency that your currency appreciates against. You're going to go out to dinner a few more times a month. You're going to buy a new car.
If the dollar goes down that much, then that would mean that the euro goes up a lot. It means that the yuan goes up a lot. The yen goes up a lot. None of those countries have growing growth either, or they do, but it's the growth of the growth is slowing. Right?
And that's where it gets tricky, right? Because now it's the question is you covered your dollar short up 20, 30%.
Yeah.
Okay, can you take that savings? Do you have the endemic demand within your society that will take that 20 to 30% and go out to eat, go on vacation, buy a new car, etc.? Europe, Japan, Japan probably not. Europe maybe. China, yeah, they probably would. A lot of the rest of Southeast Asia, oh yeah.
So how does, I'm going to use one of your arguments against me against you. Is that fair?
I'm confused now.
How does China, without dramatically, devaluing their currency, but actually appreciating their currency if the dollar gets so weak, how do they pay off all their debt?
how do they pay off all their debt? Ultimately, it's dollar denominated. And I'm not convinced they have
Or even their yuan debt.
Even their yuan debt? Oh, they're either going to have to grow or they're going to have to default, right? I mean, it's sort of the same as everybody. And, I'm not convinced they have as much debt as it says. I mean, Carmen Reinhardt had a great piece a couple months ago.
Because they owe it to themselves?
Well, no, because everyone's counting this hand of the ledger where they are borrowed a bunch of dollars. But they also have lent a bunch of dollars to other emerging markets. So somewhere on the net of that book is smaller. Now, there's timing and there's other, but the net number might not be smaller. But yeah, they do owe it to themselves. There is this element of modern monetary theory, if you will, where, if a Chinese state-owned bank has a loan to a Chinese state-owned company and the Chinese state-owned company defaults to the Chinese state-owned bank, is there a loss? Not technically, which is incredible. It has currency implications.
Yeah, I mean,
to be clear, it has potential currency implications.
I mean, that sounds like something Ben Bernanke would say, right?
and this is some of what they're doing. If you watch what they're doing, they're like, after 08, it was like, oh, those are the rules of the game?
Yeah.
Hold my beer and watch this.
Yeah.
Okay, well, if you're just going to print your way out of any trouble, why would we ever? The optimal strategy in 2008 was be big enough to crash the system if you had trouble. Because the Americans moved heaven and earth to help you. If you were small, you're done. So what did they do? They went and made themselves the biggest of the biggest, too big to fail. It's the genius strategy. It's exactly what I would have done. The optimal investment strategy is go take out as many credit default swaps with the biggest U.S. banks that you could, because then they had to save you. And that's effectively what they've done.
Well, interestingly now, the biggest banks in the world are Chinese.
Oh, right.
Right? So they're systematically important. So anyway.
That's right.
Well, I do have a big thank you to give you because, our conversations have definitely made me dig deeper than I probably would have dug before.
Likewise.
It's made me kind of crystallize what I think is going to happen over the next 2 or 3 years. I think me and you both agree where we're going to be, let's say 5 years from now. I think the path is where we typically disagree. But because you've made me crystallize it, I think part of the series that's called Skin in the Game it's one thing for us to kind of have fun on Twitter and bash each other back and forth, but I've had a lot of people ask me, what are you doing to profit from it? And the reality, for a long time, I was just kind of playing it conservative and owning gold, right? But this is a way I think to actually really profit from it. It's going to be really interesting. I'm curious, are you betting on gold for the Skin in the Game? How are you playing it?
I've got a number of different curious, or some of them are sort of esoteric ways of playing it. I own gold. I've got some equities, and I sort of move those around based on exposures. I don't do a whole lot of we don't do stock picking at FFTT, so it's sector stuff. I'll move around. It's really been about at this point levered long. Really, for me, the past 10 years have been basically levered long. I had the biggest mortgage I could take.
Yeah.
I had, the difference that I would have had down on my house in equities. It's worked out well. I've recently been starting to get a little lower over my skis. And some of that is Wall Street, I think, is really underappreciating the potential risk on the geopolitical side. And I'm a realist. If that gets worse, I think people are going to go to the dollar. You have to.
Yeah.
I would.
Well, it's always fun.
Absolutely.
We managed to get through it without
no
swearing, no headbutting and everything. So maybe we should just go grab a milkshake and get out of here. Good to see you.
Great seeing you too. Thanks for your time.